All right. Hey, what's up, guys? Today we're going to be talking about a strategy that I believe can make you anywhere from $200 to $500 a day. It's really depending on how much money you're investing with. But let me explain a little bit about this strategy in general. Most people who are day trading and want unlimited trades, there's a pattern day trading rule, and you have to have over $25,000 in your account. Now, if you have that much in your account, whether it's from savings or from trading, you're going to be well off. If it's from savings, I suggest to kind of paper trade or use a simulator to kind of get the skills before you put so much money into it. But if you've gained that through trading, then you're going to be well off. Now, most of us who are starting aren't going to have $25,000 to throw at the market. We're going to have 1,000, maybe even less, maybe even 100 just to try and test the waters. In that case, I have a different strategy. But if you're trading with 1,000 and 5,000 and you're trying to break that pattern day trading rule, grow it to 25,000 so that way you're not restricted from trading anymore, day trading, meaning buying and selling in the same day. This is a strategy that minimizes risk and maximizes the growth that you can have. So let's talk about the stocks in general. If you're new to trading, stocks can go up or down based on earnings, news that they get, or just volume in general. If more people tend to be selling off, less people are going to be confident in buying and waiting for a rise. If this chart was flipped, less people would be interested in buying. But since this chart is like this, the next day, there's a high chance that people are going to also look to see if it's going to happen again. And if they see a green candle at the beginning of the market open, they might have a likelihood of playing this as well. So really what this is there's a pre-market, there's market hours where the market's actually open, and there's after hours, and then here it closes, and then starts a new day the next day. And so that's really what we're looking at. These three stages is pre-market, market hours, and the aftermarket. You can trade during either of these, but this is where most of the volume is going to be, where most people come in and trade. And typically, some people who are day trading make their money within the first hour where the most volume is, and then they'll leave. But you don't necessarily have to do that. A lot of people do trade and continue to make gains throughout the day. So this video is specifically for someone who has like maybe $5,000 to $2,000, anywhere in that range where you want to make some extra money or extra revenue. Now, trading is risky, so you are putting your money at risk. So just like you have the potential for upside, you do have the potential for downside. But this is why we minimize risk and we eliminate as many bad choices as possible before even entering. So that way, if we take a risk and we lose, we know that we made the best play possible, or we had an idea behind it. And if you do that, majority of the times your ideas will be right. If you kind of just go all willy-nilly and pick random stocks, you're going to get random results. So I want to take a look at Roadblocks here. And this stock had good earnings, and people thought it was going to have bad earnings. So there was a lot of reverse hype. So people were selling off, and then they got good earnings, so it started going up. So as you can see, it's been going up for multiple days, even before this period. So this is when it had its earnings, right? So let's say we're not playing it here. Here, we're not even bothering because we have no idea this thing exists. But now we've had its good earnings, and we have a huge spike. So this went up 6%. Webull has a place where you can go. If you look at the homepage, whether you have the app or if you just use the website, you can go to market, and they're going to show you the top gainers and top losers. Now, typically, a top gainer, unless it's a hype play, aka like a pump and dump where people are just buying in and selling out by the end of the day, even in those cases, stocks that move like this either have good earnings, good news, or people have high volume in them. So if you find a stock that's moving this much, those are the stocks that we're going to have on our radar, right? So that's what we're looking at. Typically, if you have a good company as well on top of that, like Roadblocks, for example, they release news that they're going to be changing their game entirely. So it's something to look forward to. It's a meta play. If you're not familiar with meta, it's what Facebook is either transforming into or making on the side, and it's supposed to be more interactive and more interactive gaming format. So Roblox is in that area as well, and they updated some of their stuff. So on top of earnings as well, this is a bit of a hype play. People are familiar with the game and people are buying. So after this initial day, this is what we're going to be looking at. And this is the strategy. Let me say the strategy and then I'll explain how we'll play it. So the strategy is, okay, so see how this went down here this day? And then this day went up. So this is throughout all three stages I mentioned. This is pre-market, market hours, and then after hours. So what we're doing is not playing this market, because keep in mind, if you have under 25,000, you can't day trade only 3 times per week. So we're gonna not rely on day trading because we only have 3 of those per week. So let's rely on swing trading where we have unlimited amounts of swing trades, but we could only make them if we hold them per day. So a swing trade is when you buy it in one day and you have to sell the next market day. Now it could be pre-market. You don't have to wait till market hours. You could sell pre-market, and that's the strategy. So the key is we see how it performed throughout the day. If it had a big run up like this, typically we'd buy in the after hours. And so you'd buy in here right before the close. So for Central Texas, it's 7 p.m. So you want to buy in maybe 6:30, things like that. And then you, on top of that, you want to buy a few different stocks. You don't want to put all your eggs in one basket. That's one lesson I learned. So you want to have one, two, or three maybe, and one that's more consistent. Then you can take a few risks if you want to on different types of stocks. But if one does well, it can hedge any other losses. And if two do well, then you're doing really good. If all three do well, then you're in a really good spot. And at the end of the day, since you're buying one day and selling the next day, you only have to be right once per day. Meaning that, let's say you buy here and it goes up during pre-market. Now at market open, more risk comes in, more volatility. Something could sell off or something could go up, just like this. So it's up to you what kind of risk you want to take. But basically what we're doing, the strategy is buying in after hours and then selling the very next day. Now you might have to wake up super early as soon as market opens. For Central Texas, it's 3 a.m. And if you want to really catch a spike or a gap up, that's one way you can do it. If you want to take a little bit more risk and not watch it as much, you can wake up a little later, like a few hours after or right before market open to see where the most volume is coming in. But what I mean is that you only have to be right once per day. Is if you buy here and you wake up here, maybe like at right before market open, and you see that it's gaining volume, it's up to you if you want to sell here, or you can wait to see what happens at market open. But you only have to be right once. And if it's coming down, for example, and then you want to hold, you can take your loss there, or you can hold. And if it comes back up, then you can choose to sell there. But you only have to be right once per day. And even like a stock like this, if you're holding it multiple days, it comes down like this, and if you choose to hold, it could come back up as well. And a stock that has good potential, typically good volume as well, it'll come back up. But it's up to you how long you want to hold it. The way I started looking at this strategy was looking at as close to a day trade as possible, buying it right before market closes, selling it right before market opens, or allowing it to run up. So if it has a huge run like this, of course the next day you're going to expect some more volume. So if you bought in here after it sells off and it comes up here, you can choose to sell at whichever point. But look at the range. So from $95 right before close to pre-market $100, that's a $5 gain just before market opens in general. So if you have maybe $5,000 and you're able to buy with your $5,000 maybe 50 shares or 100 shares, and it goes up 5, that's $500 gained right there off of this stock alone. And you can choose to sell, take your $500 gain if that's your goal for the day, or if you know it's a big play and you want to hold it. If you look at the entire range, it goes up to 109, so that's $15. That's a $1,500 play off of your investment, and you can sell there. Let's say that we play the next day. So you go in, you choose a different amount of shares, you take your profit, set it aside, you put in 50 shares, and it starts to go down. You can choose to sell and take your losses there. Maybe you think, hey, you know what? Maybe this play has been milked to the absolute bottom. So you take from 109 down to 105, which is $4. So you give $400 back of the $1,500 you made. And then you look at it after hours. Look at how it performed here. So now you're at 7 p.m. It came down like this. Would you play it here? You don't necessarily have to. I probably wouldn't. Something that's coming down like this, you would think that all the hype's gone. You want to wait for the market to show you that you're right. You don't want to just take guesses like that. So I'd probably move to a different stock here. But check this out. Here it happens again where it pops up again. So then guess what? This day you might want to be your eye on it again where maybe, hey, you know what? Maybe it's not done. And since you can't swing trade, or since you can't day trade, even if this makes this move, I wouldn't buy in here because it could always come back down. But you want to wait till after hours, minimize risk. So let's say you buy here at 107. By the time it's market open, you hit highs of 111. That's a $4 gain. If you have 50 shares, that's $200. It comes back to 109. That's still a $2 gain on the shares. So however many shares you have times 2, and it comes back down. So you choose when to take your profits. But this had a big gap up there. And then this one here, I probably wouldn't have played this. I mean, if you look at this, it kind of comes down and looks up. But the thing is, if you can choose to take this risk, like if you would have, the range would be from 108 to 119, which is a $10 gain. If you have 50 shares, that's a lot of money for you. If that's what is that, $5,000? Is that $500? That's $500. So yeah, it's still a lot of money. But if you have more shares, the more shares you have, the better for you. So if you have 100 shares and it goes to 10, that's $1,000 for you. But it's really the risk you want to take. But at the same time, if it goes up without you, it doesn't mean you're losing money. And a lot of people have the fear of missing out, where they think, well, if I would have played that, I would have done this. But you're also inheriting the downside, because if you would have played this, it would have gone down. So by not entering at all, you reduce any chances of losing money, but you also reduce chances of winning money. But this is still good for you because this shows signs of strength. So then if you played the next day after this move, patterns tend to repeat themselves. So you buy in here right before market close, and the market opens is pre-market here. I mean, so it goes down. You can choose to take your losses or continue to play it. And if you did hold it, you could go from 116 to 125 during market hours. That is a $9 gain. So if you have 100 shares, that's $900. Now, the reason I said in the title anywhere from $200 to $500 a day is because you choose when to take your gains. Yes, this is probably best case scenario if you hold, but you can choose to take it early. We don't need this whole move. We just need a small bit of this. If you look at this, like this is a huge move here, but we only need about from here, even from here to here, because you don't know when it's going to start coming back down. Maybe the first sign of a weakness, you decide to sell, that's 124. That's still really good. You don't have to hold it all the way down to 129 because it could start coming back down. For example, like here, if you sold at this, like here at this top tick at the first signs of like red, you'd still make a good profit, but it could start coming back down and then you'd give some back. It's really up to you how much you want to take. And if you do this with multiple stocks, even if you do have a red day, then the other stocks can kind of act as a hedge against your losses. So if the other stocks do well and this one does bad, you can take your losses early, ride the other two gainers, and still probably come out on a profit. If you look at this one, this is a really good example of a potential loss, but you could still get a gain out of it and taking your profits. If you bought in after hours here, it'd be like around 126. And here you have highs of 134. Now, easy come, easy go. If something moves like this, a lot of the times it's not going to hold unless there's news behind it. This was a week after news. So the fact that it would come back down, this is a lot. A lot of people sold off here. They probably just took profits. This is crazy move, but you're still up. And so if you decide to sell anywhere from, let's say you bought 126, let's say you think at 130 or 132 that it's going to stop going up. Even if you just take that, that's still, what is that, a $6 gain? And if you ride it all the way to the top, you have the potential of a $12 gain. And if you have 100 shares, that's $1,200. Now, again, I don't expect us to make the absolute bottom to the absolute top. So you might take from 126 to like 134 or 130. And that's still a really good gain. And a lot of stocks really act this way. If we look at another stock here, and you want to look for stocks that are making those signs of moving up. Like, for example, Home Depot also had good earnings, and its first day it had a huge run. So the next day you could expect it to do the same thing. So we're looking at good stocks that are strong and that are making the continuous plays. So we buy in post-market, after it made this move. It shows a sign of strength. It gaps up. So you could buy in from 392. It hits highs right here of 398. That's a $6 gain. And this stock's a little bit more expensive, so you're not going to be able to buy as many shares. But that's also good because typically it doesn't drain as much. So it moves slower because it's more expensive, which means less risk. So if you diversify your investments and you want to buy one that's a little bit more expensive but less likely to have a big range, but you can still get a little bit profit off of it, you can do that. You can sell any time here while you're up. And typically the way to absolutely minimize as much risk as possible is to buy in after hours right before the close and sell as soon as market opens, which would be for Central Time, 3 a.m. 3 a.m. is when it opens. You can have gap ups, you can have gap downs, you can have slow rides up. But at the end of the day, you want to see what kind of moves you've made. and then you decide from there how you want to play it. If you're up already green, you can decide to take your money and you get a free $20, free $100. And then if you want to wait till market open, you have the potential for more. But where people lose out is if you don't have a day trade, and let's say you see a stock that's going up and you buy at the top and then it comes back down. That's where a lot of people lose money. Let's see. A good example for that one is, I know there was a stock that did that yesterday on Friday. Let's look at AMD. So this one's a good example where AMD, I believe they had good earnings, but they've been making some wacky moves. And this is not one typically that I'd probably play like the post-market strategy, because anything could really happen. It has gone down and come up, but it's just isn't as consistent for me. But let's say you were right. So you can buy it here, play it here. And if you were playing the strategy where you buy post-market and sell pre-market, you'd still make any of these points, you'd be green. But if you hold it, you end up kind of coming down. And so what a lot of people do is they'll see volume, they don't have a day trade, and they'll buy in as it's going up, expecting it to hold this level or go higher, and then it comes down. And now they don't have a day trade and they're forced to hold throughout the next day. And as you can see, the next day, even though it had volume, it didn't reach those highs again. So you're still stuck. Your capital's tied up. You're forced to either take a loss or continue to hold it, but there's no guarantee that's going to retest that high, especially with a stock like this. It's been acting very wonky. It has been going up. It has been reaching higher highs, but your capital might be tied up for a few days and you're not going to be able to play the strategy for a few days. And at the end of the day, it's not worth it when you could just play the strategy of buying post-market, taking your profits. And if it goes up without you, that's fine, because you're not at the position where you can day trade and you're just taking your profits. It's still free money. And so it's really up to you how you want to take that risk. It is a strategy that you can use, selling pre-market before a lot of the volume comes down where people sell off. And one example of the ones that sell off are Affirm. Affirm had good earnings as well, but the thing with Affirm is that its main partner is Peloton, and Peloton had bad earnings, so they expected to have really bad earnings. But Affirm did go good without Peloton, so it recovered. But so many people had bought and that volume just didn't continue, so it sold off. And so if you would have bought pre-market here, you can sell here before and then not take this risk. And you don't know when the bottom is going to be, so you just stay out of this. And if you buy pre-market here, it could just continue to dump. And that's why you want to look at the pattern of every stock. Every stock's going to be different. And here, it has its first day where it closes above where it started. So that's a sign of strength. And if you look at the next day, if you would have bought in here, you do have a chance to make some money off that because it starts showing signs of strength. Same thing here. You have a small chance. But this particular day, it had a chance. It got bad news where they were doing a private offering. Private offerings aren't so good for the shareholders because they get a selection of investors to take that private offering, and the public doesn't have opening to buying those shares. So typically they don't like that. And all the signs of strength went back away, and all of a sudden we're losing money again, or it's going down. But when it has news like that and it makes a move like this is not something you'd probably want to play the next day. It's going down. You want to look for signs of strength. It doesn't mean you have to take this off your watch list. It just means, hey, for now, let's keep an eye on this, but go to a different stock that's making better moves. So that's essentially the strategy. Let me know what you think about it. It's a strategy for people who are under the pattern day trading rule and you're still trying to make money and minimize risk. It might take a little bit of extra effort to wake up early to see where you're at, to decide to take losses, to decide to take profits. But at the end of the day, you're going to be making more gains with less risk. And of course, just keep an eye on what stock you're trading. You want to look at the previous patterns from before, and that's how you're going to make your decisions on the next day. Every day is different, so do be sure to do your due diligence and make sure to take losses, put your stop loss on, things like that. But yeah, that's going to be it for this video. Remember, this is all, trading is risky. A lot of people lose money, so you want to minimize your risk. So do as many things as possible to minimize your risk. Do your own research as well. Don't just listen to me as well. I do like kind of putting my strategies out there that I enjoy. but there's tons of things that work for different people. It all depends on how you think as well. If you vibe with the way I do my strategies, or you vibe with someone else, everybody's different. So at the end of the day, just there's so many ways to trade, but here's one that I think that can help you. So if you liked the video or got anything out of this, leave a thumbs up. If you want to paper trade it and see how the strategy works on paper, you don't risk any money. That's one way I highly recommend. Once you actually enter the trading field with the real money, make sure you know what you're doing and make sure you have your risk managed. But try this on paper, give it a few tries, do it for a week, a month, see how much you can build your account to. The cool thing about the paper trading account is you can reset your balance, and it's simulated, so there's no risk, there's no actual money being done. So this is what I'm showing you in the simulation. But yeah, all right, so that's gonna be the end of this video. If you like the video, leave a thumbs up, and until next time.